What it is, YouTube? It's your boy Don't Play Trent checking in live from the lab. Back at it again with another video here on the little account where I give you guys tips and tricks on how to grow a little account into a big deal. So without further ado, we gonna jump straight into this video here. I wanted to drop some free games, some free knowledge, and I wanted to talk to you guys about risk. Managing your risk and how to actually manage your risk when you are trading in the foreign exchange market, or better yet, when you're trying to grow a small account. So stay tuned, watch the whole video. I'm gonna show you guys exactly what I do and how I'm able to navigate the forex markets and start and grow small accounts. So first things first, you must understand that your risk is going to change per setup, right? Depending on the setup or the trade that you're taking, different trades require different risks. Depending on if it's an A plus setup, depending on if it's B plus or C plus setup, you should have already labeled what your A plus setups is, right? What trades that you like to normally take, what trades that you feel comfortable with, that you see you have the best wins or odds of winning in that trade, right? We would consider those A plus setups. Now you also have trades that you really don't like to take, but you take them just in case, or those trades that you take them just because the fear of missing out, like you kind of want to participate in the market, but you really don't like the trade setup. We would consider those C plus setups, because it happens. Even though we should only be taking high quality setups, every now and again we like to take a setup that we may be seeing, maybe looking on our phone, or maybe just out and about, and we're looking at the markets, we're looking at the charts, and we see the chart may be setting up, and doesn't necessarily mean that it's a bad trade or bad setup. It just needs to depend on the risk. So if I have a C plus setup, I want to go smaller on the risk, right? If I have A plus setup, then I want to go kind of heavy or bigger on the risk. So I'm gonna teach you guys right here on the charts. Depending on your size account, right, will determine your risk parameters as well. So if someone has a higher account or bigger balance than you, they may be able or willing to risk more than you. But you guys already know on the little account, so I like to start off with small accounts and then grow them. So how I do that, if you guys have not yet joined my group, my Discord group, where I give all of my signals, give all of my trade setups, and I share my wins and losses and basically my entire journey on my group chat. The link is in the description. I tell you guys, you see at the top where it says recommended lot sizes, and then you see I have the account size, and then I have the actual lot size. So how I trade little accounts, anywhere from $100 up to $1,000, I recommend. Now if you are starting on a little account, I recommend you start with $200. I recommend you start with a little bit over 100. If you have 200 to spare, I rather you start with 200, just to give yourself wiggle room, just in case that first, second, or third trade doesn't go your way. You still have a little wiggle room to make back up the losses, if that does happen, right? But if you guys want to start, if you guys have a little extra money to spare, then I would try to get as close as you can to either a $500 account or a $1,000 account, just because it's going to satisfy your daily limit. One thing about building your strategy, you must build your strategy and tailor your strategy to yourself and your likeliness, not just off the charts, right? You could build a strategy on the charts, but that's just not, that goes into it what makes a profitable trader. It's also how they manage their risk. So managing your risk is a big part of your trading strategy, or trading identity, period. Now most of the times you hear a lot of guys or a lot of gurus or Wall Street guys, they tell you to only risk 1% of your account, which I think is complete bullshit. Risking 1% of your account, it will take you really, really long to get to where you're trying to go. On top of this, game was built off of leverage and margin, and because it's out there, if you learn how to utilize it, you can utilize it to your advantage. So with a lot of these companies and brokers offering leverage, learn how to utilize it. Now it is a double-edged sword, so if you don't know what you're doing, then it's more than likely going to hurt you than help you. But at the same time, it is there for a reason, and a lot of people are getting rich by utilizing leverage because they know how. So I'm gonna share with you guys on the screen. Depending on your account size will depend on your risk. So let's start off with $100, and I'm gonna basically post the same exact thing that I have posted in my group chat. I'm gonna share with you guys because this is very, very valuable knowledge, and this is like one of those things that really make or break a trader because of how he manages his risk. Like I said, a trader that catches a good trade versus being a good trader are two different things. Anyone can get lucky, anyone can make a good trade, anyone can get a couple wins, right? But it's the longevity of, are you going to be able to last in this market? Let's just say, hypothetically speaking, that you were on Wall Street, right? And were you out there managing money, or you're in a hedge fund and you built $1 million up to $1 billion, right? And it took you a year. Hypothetically speaking, just pulling numbers out my ass, right? You built a million up to $1 billion, and in one day you go to the bathroom, you enter your trade. It's a high risk setup. You like to set up everything plays out. You enter your trade, you go to the bathroom. Trump sends out a tweet, and the market completely goes in your direction. You don't hit a stop loss, and you completely blow the $1 billion account, right? Does that necessarily make you a bad trader? No. So just because you take a loss, or just because you have a big win or a big loss, doesn't necessarily make you a bad trader. But on that trade at that particular time, were you a good trader? Because that trader that just blew his account, more than likely he has the skills and the knowledge to build it back up. So he's probably going to go through some pain and then get out of it, because he's going to know how to manage his risk and do what he was doing before to get himself to that $1 billion mark. But that doesn't necessarily mean he was a bad trader, or that he just took a bad trade. What he didn't do was manage his risk. So it doesn't matter what level you get to in trading. Whether you're starting with $100 account or you're on $1 billion account, it literally only takes one trade, one day at the right time to blow that account if you're not managing your risk properly. So this is why I wanted to share this, guys. This is why I want to share my tips with you guys on how I build and grow small accounts. So if you're starting your account size with, let's see here, account size, and I'm going to make it bigger for you guys. And remember when I said your account size, your risk depends on your account size, right? So account size, if you're starting with $100, let's say $100, I recommend risking 10% per trade. Right? Where is the money sign? Okay. If I am on a $500 account, I guess I'm too big. Make it smaller so it can be on the same page. Okay, if I'm risking 500, risking 10%, 10%. Oh, my bad. And if I'm on 1,000, I'm risking 100. Oh, it's okay. Guess I made it too big. I don't know why I put that there. So this is equal 50. And risking okay, so like I said, risk depends on your account size, which is the most important thing. When I'm trading little accounts, I usually like to risk no more than 10% of my account, 20 pips per trade. So 10% of my account, risking 20 pips. 20 pips, right? So stop loss, So whenever I'm trading a little account, whenever I'm starting my account with 100, 500, or 1,000, I am looking to risk 10% of my account because 10% is comfortable with me. Now remember, this strategy is tailored to me and the way that I'm comfortable with losing. Like, I don't mind losing $100 to make $500 to $600. So anytime I'm managing my risk, I'm risking 10% to make 40, 50% minimum on this trade, on every trade that I take. So I'm looking to catch a 1 to 5, 1 to 6 moves, right? That makes sense. So, like I said, for me, this satisfies my daily loss, my daily goal. Because on top of, if I'm trading $1,000 account, I'm looking to risk $100 and I'm making $500, $600. That is tailored to me and what I'm comfortable with. Because what you don't want to do is you don't want to catch a big move or a great move, and let's just say you up 100 pips, you got a perfect entry, perfect everything, and then you only made $50, $40. Like, I don't know about y'all, but I got real bills, right? And real bills mean I need real money to pay for them. So I have to tailor my strategy to what's comfortable for me. So $500 is being my daily limit. If I'm looking to make $500 a day and that's comfortable with me, it allows me to not get greedy in the market. It allows me to actually find my TP. Once price hits my TP, automatically take me out of the trade. So like I said, I'm usually risking about 20 pips to make about 60 pips minimum. So 1 to 3 minimum. But I'm really aiming for a 80 pip, 100 pip move. So the way I structure it as far as my actual lot size. So if I'm on $100 account, my lot size is going to be 0.2. So lot size is 0.02 times 4. So this would be basically 20 cent times 20, which would be 10, right? And if I'm risking 4 of them, which actually should be 2 of them, would be $20. Okay, I think I may have did this wrong. Because what I like to do is so a 0.2, basically 20 pips times 0.2, which would be 4. So it should be $4. And if I have 4 entries, two entries. So 2 entries, two entries would be about $10. $10, and then if you calculate the spread and the fees and all of that, it should be about $10 per entry, which is right where I want to, exactly where I would like to, be comfortable at losing, right? So lot size for 500 would be 1.2, and then lot size for 1,000, would be 0.25, 25 cents. So this is typically how I structure my lot size whenever I'm trading small accounts. Also, what I recommend my entire group chat to do. Because more importantly, we want to manage our risk. We want to manage the money that we actually put in and then try to take money out of the market. And the only way to do that is to manage our risk properly. Because once we manage our risk properly, and even if we take small losses, it doesn't damage our psychology. And that's the most important thing when it comes to trading, is your psychology. And it's not the losses that you take, it's how much you lose. Because you can lose 10 times in a row, but if it's only $1 or $2 that you're losing, it's not going to affect you as much if you're losing, 20, 40, 50, 65, 60, whatever your account size. If you're risking, 50, 60% of your account, on a trade setup, and you're losing, then it hurts a lot more. And what it does, it's not the loss that you need to be worried about, it's the after effect. Because what it does, it makes you not want to trade. That's 1. You lose your confidence. That's 2. And you just go in a downward spiral, and then you start to play tricks in your head. Is trading for me, this and that. And it's only because you took a loss that you shouldn't have took, because you over leveraged your account in the first place. So whenever you guys are trading your accounts, like I said, I pretty much did the math on this. here. So if I'm risking 1.2, which is basically 1.2, and if I have two entries, so let's do 1.2 times 20, which is 24, and then you do that times 2, that's about 50. So 1.2 times 2, and then 0.25 times 2. And the reason why I like to split my entries is because I'm tailoring to my TP. So again, your risk management also has to be tailored to your TP. So remember when I said I'm looking to get 60 pips, that's a 1 to 3 minimum. That's where I'm closing out my first entry, period. So entry number 1, and don't confuse entries with trades. So this is all one trade, it's just divided into entries. So I may be taking this trade here at 9 o'clock, but I may have 3 entries at 9 o'clock. And then on the same trade at 9:30, I am adding 3 more entries, right? This is still considered one trade, but we have multiple entries, especially once you learn how to scale in and manage your risk. But 2 entries is one trade, right? Because instead of us putting a 0.4 lot size in, we only put a 0.2, and then we just put it twice. That way, we able to take some off the table, and we able to let some run in case the markets wants to act wild and continue to go because Trump said something. Trump sent out a tweet or something. The market wants to just take off. We want to just take off with it. So like I said, I usually tailor my TPs and my stop losses to what fits me because I want to pay myself and I also want to catch the whole move. So I tailor my strategy to, one, I take out profit, which is me paying myself, which is also the cost of doing business. And then 2, I sometimes like to catch the whole move, so I'll let a runner run and just see how far this trade will actually run. So again, this was my strategy when it comes to managing risk on how to build small accounts. I recommend you guys risking no more than 10% of your account. You hear a lot of people talk about 10. Don't risk no more than 1-2%. That's if you're a beginner. If you're someone that's just now hearing about forex or hearing about the charts, only risk 1% of your account because what you don't want to do is you don't want to damage your psychology. If you come in risking big, and if you're new, you're just gonna lose money, and then that's just gonna damage your psychology, and then you're gonna quit. You're not gonna want to trade no more. Like, who wants to jump into something that you have to pay for, and then you're constantly losing? Because this is a journey. This takes years to get to a certain point. So understand that what you don't want to do is you want to stay level headed. You want to make sure that you're able to last and stay in the game. So I recommend 10% of your account because 10% of your account, you have 10 tries. I look at it as you have 10 tries to lose this trade before you're able to get that one win. And once you actually get that one win, you can start compounding your account to make up for some of the losses that you may take. So if you guys have found any value to this video, do not hesitate to hit that subscribe button. Go ahead and like this video. If this video also gave you, some type of knowledge or some type of edge when it comes to trading, trading in your pair or whatever instrument that you trade. Also, let me know in the comment section, you guys' stop loss and what is your strategy when it comes to handling risk. I'm open to learning. I'm a student to the game, so I'm open to learn if someone else has something that's a different way of viewing the market, a different way of managing their risk. But again, it's Don't Play Trent. I am checking out. I'm going to see you guys on the next video. And again,